Hello and welcome to SRA Accounts Rules Compliance, where we're looking at the new SRA Accounts Rules which came into force on the 25th of November 2019. My name is Jenny and I'm joined by my colleague Faye. Our contact details are on screen if you have any questions at all about this webinar. This webinar covers the main changes between the 2011 version and the latest version of the SRA Accounts Rules.
So let's start with a bit of background. The new SRA Accounts Rules came into force on the 25th of November 2019. The 2011 rules were originally published in April 2011. There were various updated versions, with the last one being version 21 on the 6th of December 2018, which is when pricing transparency was introduced. The rules followed the Clementi Report and the Legal Services Act. Clementi was tasked by the government in 2004 to review the regulation of legal services with a view to improving competition, innovation and consumer protection. He was also asked to suggest a new framework which would allow this to happen.
So let's have a look at what's changed. The 2011 version of the SRA Accounts Rules included 52 rules. They consisted of 27,000 words over 80 pages. And the rules also had embedded guidance notes.
The 2019 rules include 13 rules, which are 2,000 words over 6.5 pages, and the guidance notes are separate.
The 2019 rules are broken into 4 different parts. Part 1, General. Part 2, Client Money and Client Accounts. Part 3, Dealing with other money belonging to clients or third parties. And Part 4, Accountants' Reports and the Storage and Retention of Accounting Records.
So let's have a look at what the main changes are from the 2011 to the 2019 rules. All of the previous timescales, so 14 days, 2 days, etc., have been removed and firms now have the freedom to come up with their own timeframes.
All of the rules are considerably shorter than they were. For example, the previous Part 3, Interest, has been condensed from 4 rules and 22 guidance notes to just 2 sentences. As we've already said, all of the old guidance notes have been removed.
Where the only client money that firms hold is money received in advance for fees and disbursements for which the firm is liable, firms can hold these funds in office account if they wish, provided they inform their clients in advance. In addition, money received from the legal aid agency for costs can be held in the office account.
Cease to hold audits will no longer be required where the firm ceases trading or changes status unless the SRA specifically requests one.
Under the 2011 rules, firms could transfer money from the client account to reimburse themselves for amounts spent or incurred on disbursements without first issuing a bill. Under the 2019 rules, firms have to give a bill of costs or other notification of costs incurred to the client or paying party before they can transfer the funds from the client account. The SRA's definition of costs includes disbursements.
The distinction for professional disbursements has been removed, as has the concept of agreed fees. Under the 2011 rules, money received for an agreed fee could be held in the office account, even if a bill had not been raised. Now, the money will need to be held in client account until a bill is raised, unless the firm can take advantage of the change in relation to instances where the only client money firms hold is money received in advance for fees and disbursements for which the firm is liable. As we've mentioned before, in instances such as this, firms will be able to hold these funds in office account if they wish, provided they inform clients in advance.
The 2019 rules now formally require the COFA or a manager of the firm to review and sign off the client account reconciliations. In addition, any differences on the reconciliation should be investigated and resolved promptly.
The 2019 rules give firms the option of using third-party managed accounts or TPMAs rather than holding money in client accounts. If you did go down this route, as the providers of TPMAs are SCA regulated, you would not need an SRA Accounts Rules audit. In fact, the SRA has suggested using a TPMA alongside a general client account to bring your client account balance below the threshold for requiring an accountant's report. You should note that the firm will not earn any interest on funds put into a TPMA and would need to pay management fees. In addition, as you must ensure that the transactions are accounted for properly, it's hard to see that it will save much in the way of administration. In reality, we've not seen many, if any, firms using these yet.
Previously, clients' own accounts were subject to just a few of the accounts rules, mainly in relation to record keeping and obtaining bank statements. Under the 2019 rules, firms that operate clients' own accounts will need to reconcile them. We will be covering clients' own accounts in more detail in a later webinar.
The current exemption for not needing an accountant's report are unchanged from the 2011 accounts rules. However, the definition of a statement or passbook balance for the exemption test has been expanded to include balances held in any joint account or client's own account operated by the firm.
So, what should firms have done ahead of the change to the 2019 accounts rules? Firms need to have clear documented systems and controls so that everyone in the firm is aware of what its procedures are. Firms will no longer be able to assume that new joiners will know what they are supposed to do, as they may have been used to very different systems and timescales elsewhere. You will also need to provide training on your new procedures to all staff. Key areas to consider when documenting the firm's systems and controls are
banking of client monies received. This is moved from the same or next working day to promptly. The firm needs to think about what this means for them, particularly where a firm has several offices or there is no local branch to pay money into.
Office credit balances. Transfer of client funds held in the office account. How often should these transfers be performed? Guidance issued by the SRA suggests that firms who review office credit balances on a weekly basis will be considered above adequate. Monthly basis is adequate, but balances ignored or not corrected within a month are below adequate.
The SRA also released guidance in respect of overdrawn client balances. Where overdrawn client balances do not arise at all, firms are considered to be above adequate, and many accounting systems have a feature to ensure that these don't happen. Firms who review for overdrawn client balances on a weekly basis are considered to be adequate. And again, if no checks are performed at all or overdrawn client balances are not corrected within a month, they're considered to be below adequate.
The 2011 SRA accounts rules included a rule stating that funds earmarked for costs must be transferred from the client account to the office account within 14 days. This rule no longer exists, but it's important to consider what you will implement as your own internal deadline. Whilst extending 14 days might seem appealing from an administrative perspective, transferring money you are owed from client to office less than twice a month could be detrimental to the business's cash flow.
Have you identified all of the firm's client's own accounts? Balances held in client's own accounts and joint accounts are now included when looking at whether a practice can have an exemption from the obligation to deliver an accountant's report.
Does your coffer have a good understanding of all the elements of a client bank account reconciliation? Are they happy to review them and sign them off? Do they know what they're looking for?
Thank you for listening. This is the first in a series of webinars covering the 2019 SRA accounts rules, so please look out for the next instalment. Our contact details are on screen now, so please get in touch if you have any questions.